Good morning, students. Good morning, Mr. Caledon. Welcome to Financial Accounting 2, the last lap, the last term. We've got two very exciting topics for you, students. Those of you who had a look at the subject guide and the work program will know what they are. It's firstly the statement of cash flows, and then secondly, we are going to be looking at foreign exchange transactions from the perspective of an importer. But first of all, let us focus on the statement of cash flows. Now, students normally tell me that this is the most challenging topic in financial accounting too. So we'll have to be on our A game. We'll have to be very, very alert and very attentive. In fact, ladies and gentlemen, I think it's also the most satisfying topic because it really tests your accounting skills and your accounting prowess, as you'll see later on during the next few weeks. But at the end of the day, if you understand what is required, how it must be presented, how do we arrive at those figures, what are the techniques that we can use and the methodology that we can use, then it becomes actually very easy. So it is all up to you whether you are going to find it difficult or easy. If you put in your elbow grease, then you should find it easy at the end of the day. Let us just go back to the start of this year. You remember we first dealt with the conceptual framework, and then we looked at the presentation of financial statements IAS1, International Accounting Standard number 1. Now, at that point in time, you'll remember we said that IAS1, the presentation of financial statements, applies to all the financial statements except for the statement of cash flows. Now, there are two major reasons for that. The one is the obvious one. There is a different financial reporting standard, namely IAS7, that deals with the statement of cash flows. But there's also one other important reason, ladies and gentlemen. If we think back to the first term, when we discussed IAS1, we said that one of the principles, one of the systems or methods that we are using is what? The accrual system. The accrual system. And you remember we gave all sorts of explanations and definitions of the accrual system. And clearly, the statement of cash flows cannot use the accrual system. The accrual system, in a nutshell, maybe we can just repeat the general idea behind it, is that a transaction or event is recorded when it occurs or when it takes place, not necessarily when the money flows. A classic example of that was where we had credit sales. So if you have credit sales today and that customer is only going to pay you, let's say, at the end of October, you are going to record that credit sale today. So, in other words, you're going to debit your accounts receivable and you're going to credit sales. That is, in effect, the accrual system in action. So, you have accrued that sale even though you are only going to receive the money at the end of October. But in the case of the statement of cash flows, we are only interested in the flow of cash. Now, one other thing that we perhaps can just mention here, we are going to start off by looking at the history almost of this statement, because I think that will give you a clear idea where the statement comes in. Now, if we look at the other four financial statements, our statement of comprehensive income, our statement of changes in equity, our statement of financial position, the various notes to those statements, they provide us with a lot of very valuable information, right? They provide us with information about our profitability. They provide us information about our assets and our liabilities and what is the structure of our equity. Uh, and so forth. But the one thing that those other statements do not supply us with is where did our money come from and where did our money go to, right? And about 50 years ago, this was realized by the then IASC, the International Accounting Standards Committee, which eventually, as you now know, became the IASB. They realized that a new statement had to be designed in order to see where your money came from and where your money went to. And the first version of this statement was actually called a statement of source and application of funds. A statement of source and application of funds. About 30 years ago, that statement was done away with and the statement of cash flows was introduced. Now, ladies and gentlemen, why I'm mentioning this little history lesson here is that the statement of source and application of funds, the old one that we are not using anymore, actually sort of still lives with us in a certain guise. The only thing is now we call it the indirect method, the statement of cash flows on the indirect method. So the indirect method is basically the representation of the old source and app, as we used to call it, the statement of source and application of funds. But then a new way, a new template or a new layout was designed for the statement of cash flows. And this is the one that you currently see in front of you, which we now refer to as the statement of cash flows on the direct method. It's all in your textbook, so you can go and read up on it as well. So we call this the direct method. So what has happened, ladies and gentlemen, over the years, over the last few, let's say about 2 or 3 decades, a certain trend formed. And most companies, I would almost say 99% of companies in the world nowadays apply it as follows. They present the statement of cash flows on the direct method as the face of the statement. In other words, the main statement that is part of the five financial, or at least five financial statements in your complete set of financial statements, right? So the statement of cash flows on the direct method is therefore our main statement or the face of our statement of cash flows. And there we are only going to disclose the flow of cash. However, as part of this evolution over the last 3 decades, most companies are also showing the indirect method as a note, not the whole statement. I'll talk about which part of the statement in a few minutes, but the indirect method is now being used as a note in your financial statements. In other words, a note to your statement of cash flows. Now, if we just look at this direct method, the face of our statement here, we see we've got a subtotal. Our very first subtotal there is called cash generated from operations. Cash generated from operations. Now, I'm going to give you a lot of little warnings and hints and ideas during the course of the morning and afternoon, ladies and gentlemen. So, like I say, you've got to be quite attentive here. So that is called cash generated from operations with an S, not cash generated from operating activities. We'll come back to what that means a little bit later. But I just need to point that out at this stage. That is cash generated from operations. Now, in fact, ladies and gentlemen, the only difference between the direct method and the indirect method is how you arrive at the cash generated from operations. All of the rest of the rest of the statement, and we'll see it goes right down to there, and we're going to talk about all of that during the course of today. The rest of the statement is exactly identical, irrespective of whether you use the direct method or whether you use the indirect method. The only difference is how you calculate and how you disclose that one, the cash generated from operations. So if this is now our main statement, let us go and have a look at the note. The note, which is now the cash generated from operations disclosed using the indirect method. So here you can see it also ends with that exact same description, cash generated from operations. So that is where our note ends. right? So that cash generated from operations, calculated and disclosed by using the indirect method, must obviously agree, that amount must obviously agree with the amount that you are going to show on the face of your statement of cash flows, as also cash generated from operations, right? So that is also something that we need to be clear on. Now, ladies and gentlemen, before we look at the various activities, you can see that using the direct method, there are only two items, two line items or disclosable line items that you are going to show that will give you the cash generated from operations. And those are cash receipts from customers, and we'll come back to the term customers in a few minutes, cash received from customers, and cash paid to suppliers and employees. So you can see it all has to do in on the face of the statement of cash flows. It all has to do with the flow of cash. So another little hint, let me give you another hint here now, ladies and gentlemen. Please make a note of this, either mentally or in your notebooks. There are no incomes on the face of the statement of cash flows. There are no expenses on the face of the statement of cash flows. There are no assets on the face of the statement of cash flows. There are no liabilities or equity on the face of your statement of cash flows. When we get to the note, the indirect method, that is a different matter. But please, ladies and gentlemen, as soon as you have as you have something on your face of the statement of cash flows that says profit profit on or loss on, or perhaps just share capital, or perhaps just long-term loan, then it is not a correct description, because then it does not describe the flow of cash. It only describes either an income or an asset or a liability or an expense, right? And those items, those elements are disclosed on the other statement. So this is now completely new information, right? This is the flow of cash. When we get to the note, there is that works a little bit differently, because there we will see that certain kinds of incomes and certain kinds of expenses will be taken into account in calculating our cash generated from operations. But here on the main statement, it only shows the flow of cash. Now let us just go down again to the note. Here we'll see it's a different matter. Whereas in the direct method, we only look at, when it comes to the cash generated from operations, we only look at the dealings and wheelings with our customers and our wheelings and dealings with our suppliers and employees to calculate our cash generated from operations. But in the indirect method, it works differently. Here we actually start with our profit before tax. In other words, we start with a figure that we find on the face of our statement of comprehensive income. The statement of performance, you can call it your statement of profit or loss, or your statement of comprehensive income. If you are using the one statement approach, you remember all about the one statement and two statement approach. But anyway, we are using the one statement approach, so we call it our statement of comprehensive income. So we've got a figure there. We start here with a figure that comes from the face of our statement of comprehensive income. And clearly, ladies and gentlemen, that profit before taxation or profit before tax includes all your income items. It includes all your expense items, right? That is how you arrived at the profit before tax, and you arrived at those expense and at those income items by using the accrual system. Then we've got to do two kinds of adjustments. We've got to do two kinds of adjustments to that figure in order to arrive at our cash generated from operations. First of all, and this is what this first section is all about here. We'll talk about this indirect method later on, possibly even next week. Only we'll see how far we get. So firstly, we're going to adjust that profit before tax, which includes all our incomes and all our expenses, to take out, to exclude any income or any expense that does not relate to our operations, right? So that is our first kind of adjustment, something like depreciation. Depreciation, as we'll see later on, relates to investing activities, right? So it's not part of your operations. We'll talk about those items later on. So you take out, you eliminate, you exclude all income and expenses that are not part of your operations. Once you've done that, you have not converted this to a cash flow yet, but at least you've converted it to either a profit or loss that only relates to the operations. And we give it a little name there. We call it an operating profit before working capital changes. Now, all of these things we are going to discuss in detail later on. I'm just giving you the overview, the framework here. Then our second kind of adjustment is to adjust for changes in working capital. And we'll see later on, either today or next week, or sometime in the next week or so, we'll see what is meant by working capital. We'll see what is meant by changes in working capital and so forth. But what that really does, what the intention of that is to eliminate the effect of the accrual system. Now, if I say the effect is that you are eliminating the effects of the accrual system, means that you are converting that operating profit or loss to a cash flow, to a cash flow. So you're taking out the impact of the accrual system so that the only thing that remains is actually the flow of cash. And that then provides you also with cash generated from operations. Okay, so that is basically the structure of the note, right? But today we are going to mostly focus on the direct method, in other words, what we refer to as the face of our statement of cash flows or the main statement. And then we'll come back to this note, which is the indirect method at a later stage. Right. So, ladies and gentlemen, let us now focus on our direct method, the face of our statement of cash flows. The first thing that I think stands out here, if we just scrutinize this statement, we can see that it consists of four areas or four sections. Let's rather call it sections, right? It consists of four sections. What are the four sections? Let us have a look. And this is normally the order in which we present it. I know IAS7 is probably the least prescriptive of all standards, but still, there are certain protocols that we've got to follow. The normal protocol, of identification, all about that, the name of the business, the name of the company. We identify the particular statement. In this case, it's the statement of cash flows. We identify the period that it belongs to. In this case, it is for the year ended, let's say 28th of February 2021 or whatever. We obviously have a column for notes, and we identify our reporting currency, right? So that is standard with all our financial statements. But anyway, coming back to the four sections, here we can see our first section is cash flows from operating activities. I've made a little note late last night, right at the bottom here, that one must be careful with the heading, because if there's actually a net outflow of cash, a net outflow of cash from your operating activities, that description might not be so appropriate. So I would rather suggest that perhaps use the words cash effects of operating activities. That is what we basically typed here. It will be more appropriate to caption this section as cash effects of, let's say, operating activities rather than cash flows from operating activities if there had been a net outflow of cash from that particular activity. So the choice is yours. Like I say, IAS7 is probably the least prescriptive of all standards. They don't even supply a model or a typical one. One has just got to sort of from what the requirements are. You've got to design your statement of cash flows. Okay, but anyway, I digress. So our first section deals with operating activities, and we'll come back to operating activities soon. Then our second section, ladies and gentlemen, deals with investing activities, right? So you can call your heading cash flows from investing activities or cash effects of investing activities. So that is our second major section. Then we've got a third major section, and that is cash flows from or cash effects of financing activities. Now, originally, about 50 years ago, when the original or the precursor of this statement of cash flow was designed, in other words, the source and app, those brilliant minds at the IASB or the IASC at that stage still, they basically analyzed a business and they found that a business has got three distinct activities. It's operating activities, which we are going to be discussing soon. It's investing activities, which we are also going to be discussing. And then it's financing activities. So those are clear activities where you can either generate money, right? You can either receive money from that activity or you can spend money in that activity. If we just look at perhaps the operations itself, in the case of cash received or cash receipts from customers, that is the generation of money, right? So money was generated by having sales and your customers paying for the sales. Your dealings with your suppliers and employees, your suppliers would have supplied you with inventory or internet services or printing and stationery or water and electricity or whatever, and you had to pay them for that, right? So the point really is that those are the three major activities that either generates cash for you or where you have to spend cash in as a company, right? So those are our first three sections: operating activities, investing activities, financing activities, and then there's a fourth section here at the end, which is simply a reconciliation section. A reconciliation section. So first of all, you are going to add up all your totals and subtotals here. And then you are going to find what was either the net increase in cash and cash equivalents for the year. In other words, how did my money become more, right? Or what was the net decrease in cash and cash equivalents? How did my money become less from last year until this year? And then that difference between what our money was in the form of cash and cash equivalents, in other words, our various bank accounts, such as a current account, our savings account, any money that is readily accessible. We'll see if it's not readily accessible, it'll be regarded as an investing activity rather. But that's a topic for a next time. Then we're going to reconcile it by saying, what was our cash and cash equivalents at the beginning of the year? In other words, we look at our comparative figure or comparative figures, if you wish, in our statement of financial position, or to put it differently, your last year's current year column. And then you look at this year's current year column, what is the total cash and cash equivalents? And that should then reconcile, because clearly this whole statement is the information, and it describes and discloses how your money, your cash and cash equivalents from the start of the year to the end of the year, how it changed, how it either increased or how it decreased, right? By the way, little hint here again, ladies and gentlemen, if this figure here, once you've added up, once you've casted, once you've totaled this whole current year column, if that is a negative, it indicates that there was a net outflow of cash. So then you are going to describe it as a net decrease in cash and cash equivalents. And also, then, if that is a positive, ladies and gentlemen, that means there was a net inflow of cash during the year. So then you are going to describe it as a net increase in cash and cash equivalents, right? Then, ladies and gentlemen, also just a little hint here. I know this is something that students very often miss. So I'm just going to give you a little hint here. Sometimes you may find in your statement of financial position that you've got a positive bank balance in 1 year and you've got an overdraft, a negative balance in a different year. So please, ladies and gentlemen, when you are drawing up this direct method, this statement of cash flows, please refer to your current assets as well as your current liabilities. Because in the 1 year, you might have a positive balance, which will then also be indicated as a positive year. And in the other year, it will not be a current asset. It might have been a current liability, such as a bank overdraft, which will then be indicated as a negative year. Okay, let us just pause for a few seconds there. Let us just check. Are there any questions from your side? Should I take that as a no, or should I take that you can't hear me? Can somebody just give me? Oh, we can hear you. Thank you, Mr. Canadian. Okay, so no questions at this stage. Okay, that was already a mouthful, so there's a lot of information there to digest. But anyway, this is just the start. Okay, thank you for those responses. Thank you, Mr. Caledon, as well, and students. Okay, so now let's go and look at those three sections, ladies and gentlemen. Let us start with the operating activities part. The operating activities. This, let me just see, I had a ping there. Letitia, it is already available on Blackboard. Okay, if you go to Content General, then you go to the subfolder called Notes and Question Banks. Then you'll see there's a document called Question Bank on Cash Flows, or Cash Flows Question Bank, something like that. What we are discussing now are really the first 2 pages of that document, right? So it is already available on Blackboard. So you can go and open it up if you wish. If it's not there, somebody must just tell me. But I'm sure we've made it available over the recess already. Okay, so let us look at our operating activities section, the first of those 4 sections, or the first of the 3 activity sections, if you want to put it that way. Let me just see. It is there. Thank you, Melanie. Thank you. So it is there. There we've got confirmation. So the operating activities section, you can basically distinguish between 2 subsections. 2 subsections, ladies and gentlemen. The first subsection consists of the first 3 lines. And the first 3 lines we refer to as our operations section, right? Our operations section. That is why it's called cash generated from operations and not cash generated from operating activities, because that section still carries on. So our operations part is just the first 3 lines. In other words, our wheeling and dealings with our customers, our wheelings and dealings with our suppliers and our employees, and that provides us the cash generated from operations. So So basically, sorry, I was just reading in the chat there. So basically, ladies and gentlemen, if we can summarize that little section, we can see that our operations consists of the money that we receive from our customers and the money that we pay to our suppliers and the money that we pay to our employees. And that's it, right? So it is really, in effect, our normal day-to-day trading activities, right? So our operations, if you want to call it a definition, can call it a definition. But anyway, our operations, those are our normal day-to-day trading activities. I know I'm repeating this now for probably about the fourth time. So it's our wheelings and dealings with our customers, and it's our wheelings and dealings with our suppliers, and also our remuneration paid to our employees. Now, ladies and gentlemen, let me ask you a little question here before we carry on with the rest of that section. You can see that that first line item is called cash received from customers. It is not called cash receipts from debtors. Why do you think it's called cash receipts from customers and not cash receipts from debtors? Someone can tap in for us, maybe a little answer. You're welcome to say it in person. I know it's a little tricky question. Does anybody want to take a stab at it? Yes, there's a hint. Thank you, Asive. Thank you, Bella. Thank you, Kulani. Right. Thank you. I think Enrique as and Tembela and Asive, they've really summed it up very well there. The reason is it includes the money you receive from cash sales. In other words, they were never debtors. There we go. Thank you, Simon Kiwe. That is exactly it. It's because also cash sales are included in there. So when it comes to the money, the cash that we receive from our customers, it is the money generated by cash sales, which is immediate. If it's a cash sale, we get the money today. If the customer swipes their bank card, the money is in our bank account immediately, right? So that's a cash sale. As soon as at the point of sale, that credit card or debit card has been swiped, or even if they pay us in physical cash, right? So the cash received from customers includes the cash sales, but also eventually when our debtors pay us that money. In other words, our credit sales, but not on the date of the sale, because this is not the statement of comprehensive income. We are not using the accrual system here. We only are going to recognize the money that we receive from our debtors. In other words, for credit sales, when we receive the money, right? When they pay us, ladies and gentlemen. That is the big difference. We'll see later on, possibly today, otherwise within the next week or so, how we can use certain figures in our other financial statements to arrive at those figures. For instance, how do we get the money that we receive from our debtors, right? But anyway, as you've correctly pointed out there, students, you're quite correct. We call it cash received or cash receipts from customers because it includes our cash sales as well as the money that is paid by our credit sales, our debtors, in other words, our accounts receivable, when they eventually pay us in 30 days or 60 days' time. Right. Just an important little point there. Then, ladies and gentlemen, once we're done with our operations section, this operating activities main section still carries on. It still carries on. Now, we can debate this part for till the cows come home for the whole day, but I don't want us to go too deeply into it, but we can if you want. Anyway, so we've got our subtotal now, cash generated from operations. Then we've got a possibility of a maximum of 5 other activities that are regarded as operating activities, but they are not part of your operations. In other words, they are not, it has nothing to do with your dealings and wheelings with your customers. It has nothing to do with your dealings and wheelings with your suppliers or with your employees, but they are still regarded as operating activities because they are it's either money received or money paid in the regular course of business. So, ladies and gentlemen, it is just important for us to, quite a few things are important for us here, actually, not just one thing. But the first thing is that there are only the 5 possibilities as a maximum. So, if you have no interest income, then it's unlikely that you would have received interest. And we're going to talk about the different terms in a few moments' time, right? If you had no interest expense or finance cost, then it is unlikely that you would have paid interest. It is not impossible, as we'll see later on, because there could have been an accrual at the beginning or end of the year that was actually paid during the course of the year. But anyway, that we'll look at a future stage. So your only 5 possibilities, ladies and gentlemen, is either interest received or interest paid or dividends received, or dividends paid, or income tax paid, or any combination of them, right? So you can have 1 or 2 or 3 or 4 or all 5, depending on the circumstances. So that is the first thing that we've got to get clear, right? Those are the 5 that needs to be included there. Now, ladies and gentlemen, like I said, I don't really want to go into this debate, but let's just maybe look at the debate. IAS7 also allows us to show something like interest received and dividends received as part of our investing activities. But I'll tell you soon why that does not happen in practice. The same with your interest paid and dividends paid. You are allowed by IAS7 to show it as part of your financing activities. But in practice, nobody does that, right? In practice, what really happens is that everybody discloses, and when I say everybody, I'm talking about possibly 100% of companies in the world, disclose the income or the cash received from the income and the cash paid by virtue of the expense as part of the operating activity, so that only the capital that was, in the case of financing activities, let's say that was borrowed, is shown there, and only the capital that was repaid will be shown as part of the financing activities. But the cash flows relating to the income thereon or the expenses thereon will be shown as part of our operating activities. Right. So our first major point here, ladies and gentlemen, was those are the only 5 items. So we can basically memorize them, and then we know that we won't forget or we won't omit any one of them. The second one is that even though they are very closely related in the case of interest received and dividends received to your investing activities, we still show the income thereon as part of our operating activities, not operations, but the other operating activities. And even though interest paid and dividends paid is closely related to your financing activities, we do not show them as part of the financing activities because it doesn't represent capital, right? It only represents the cash flows on either income or expenses. And then we've got the odd one here, our income tax paid. Then the third important thing here, ladies and gentlemen, the third very important thing here is you must now pay very close attention to the description here. This, for instance, is called interest received. Now I'm going to ask you a few tricky questions. Maybe they're not as tricky as I think they are, but maybe they are. Who knows? We'll find out in a few moments. Ladies and gentlemen, We said earlier that on the face of our statement of cash flows, we are only disclosing the flow of cash. We are not again disclosing incomes or expenses. But, ladies and gentlemen, we must use the income and expenses and do a few tricks with them. We'll see what techniques we can apply when we get to it, ladies and gentlemen, especially when we get to our exercises to arrive at the cash flow. So now I'm going to ask you a few questions. In fact, I'm probably going to ask you exactly 5 questions. Okay. When it comes to interest received, to which income is it directly related? Something that we find as part of our revenue in our statement of comprehensive income. So interest received, which is a cash flow. Remember, when we say we received interest, it means the money was paid into our bank, right? So it is a cash flow. But that cash flow called interest received is directly related to a specific income. Which income? Simnikiwe, you want to say something? Yes, Simnikiwe? Simnikiwe? Or was that an accident? Anybody can either tell us in person or you can type it in the chat. To which income is interest received directly related? It's easier than you think. It's more obvious than you think. What did we call that kind of income in our when we did IAS1? It's part of our revenue. Revenue from? It's probably too obvious. Interest income. Thank you, Fanny. I don't know which of the two Fannies it is. Thank you, Angel. Thank you, Zintley. Exactly, ladies and gentlemen. Thank you, Zama, as well. Right. Interest income. So once we have interest income in our statement of comprehensive income, then the chances are almost 100%, not necessarily 100%, but we'll get to that later on. But the chances of, or the odds are very high that we also would have received interest during the course of the year. But remember, the difference between the two is that interest income has been derived by using the accrual system. So if there is interest owing to you at the end of the year, whether it's last year or this year, whether that interest income was owing to you, it means you have already recognized it as income in your statement of comprehensive income, but you haven't received it yet. So you are not going to include it as part of your interest received. Okay. Anyway, if that sounds a little bit weird to you, it'll all become very clear when we get to our various exercises. Now let's look at interest paid, ladies and gentlemen. Our next question: interest paid. Again, the word paid means it is a flow of cash. That is important for us. So you can see in each case, all 5 of these items, they either refer to as received or paid. Nowhere do you see income or expense because those are different animals, right? When it comes to our interest paid, ladies and gentlemen, to which expense is that directly related? Interest expense. Thank you. You get the idea. There we go. Now you into the game, right? Interest expense. And what do we disclose interest expense as on the face of our statement of comprehensive income? If you remember from the first term, what do we disclose our interest expense and our the interest expense can be on loans, it can be on finance leases, for instance. There I've given you a hint. Can be on loans or it can be on finance leases. What do we disclose our interest expense in our proper statement of comprehensive income? We know it's got to be disclosed on the face of that statement. Yes, finance cost. Remember, finance cost, ladies and gentlemen, right? So that includes your interest on overdraft, your interest on loans, your interest on debentures, any finance charges that you incurred on financial leases and so on, right? Let's go to the next one, ladies and gentlemen. I know that you now know the rules of the game, so this will become easier and easier. But I still want us to go through all five. When it comes to dividends received, now, if we say dividends received, it means we are indicating a flow of cash. And again, we're going to ask to which income is dividends received the flow of cash? To which income is that directly related to? It's also part of your revenue normally. Easier than you think. Or should I say more obvious than you think? Dividend income, investment income, yes. So, Davina, just be careful with investment income because that is a little bit of a generic term. So your investment can even interest income can be investment income. But I agree with your sentiment. Let me put it that way. But Enrique and Asive, yes, that is more specific. So your cash flow called dividends received is directly related to dividend income. So if you have dividend income, thank you. One of the two pennies, I don't know which one. uh, so if you've got dividend income as part of your revenue, and that is part of your statement of comprehensive income, you will in all likelihood also received. Right. Let's go to the next one, ladies and gentlemen. This one is a little bit different in the sense that it's not related to an expense. It's related to something else. Not an expense, not an income, but something else. So if we look at that one, oops, what did I just do? I just lost my. There we go. Sorry. Um, if we look at dividends, where are we now? Let me just see. Dividends paid. If we look at dividends paid, to which item, and now I'm not using the word income or expense, but to which line item in your other financial statements is that directly related to? To which other line item or which line item? Not retained earnings, but thank you for trying. I appreciate that. But you're in the right statement now, Angel. You're in the right statement. It is something in your statement of changes in equity. It is one of those items that reduces your retained earnings. What happens when you want to distribute some funds to your shareholders? Enrique, nice try. I think thank you for trying. Thank you for trying. But shareholders for dividends, that relates to a liability. But you're on the right track, but not quite there yet. It's distributions there. Mr. Caledon gave you a nice hint. What do we call that? Remember that process. There are three. Yes, Mr. or Miss Kalimashi, would you like to answer?
Yes, sir. I think it's the buyback of shares, share buyback.
A share buyback also can, in this case, no, because a share buyback will reduce your issued share capital, and then you obviously account for it or you disclose it as treasury shares once you've bought it back. But this relates now to the way in which you distribute your retained earnings to your shareholders. Now we're getting close. Thanks, Angel. We're getting very close. Interim dividend is part of it, but there could also be a final dividend. Anyway, ladies and gentlemen, let's get to the answer. It is called dividends declared. Remember, when we have that whole process, a dividend is first of all proposed by the directors, and then at the general meeting, the shareholders must approve that, and then we say that it has been declared. In other words, now a present obligation exists. So then we are going to record the dividends declared on the debit side, and as some of you mentioned there, we're going to raise the liability on the credit side, which is your shareholders for dividends, right? So anyway, the line item that we were looking for is dividends declared. Okay, so if either ordinary dividends or like Davina says there, ordinary dividends or preference dividends, so any kind of dividend. And like Angel said, it could be an interim dividend or it could be a final dividend, but at the end of the day, you are going to combine them. So it's going to be your, uh, uh, like Mr. Mbana says, there it's going to be your interim dividend plus your final dividend. So all the total dividends that were declared during the course of that financial year. Right. Anyway, so it's your dividends declared. Then, ladies and gentlemen, the fifth and last one is income tax paid. Income tax paid. Once again, the fact that we use the term or the word paid or received, in this case it's paid, means that it indicates the flow of cash. So now you know the rules of the game. So we're going to ask again, to which expense? This time it is actually an expense, right? So it's not such a mysterious one as the dividends paid. To which expense is your income tax paid closely related? Income tax expense. Thank you, Angel. Thank you, Asiwe. Your income tax expense. Thank you, Fanny. Uh, Either Inati or what's the one in my group? I forget now. Sorry about that. Um, Anyway, so it is closely related to the income tax expense. So if you are disclosing an income tax expense on the face of your statement of comprehensive income, that obviously, as you know very well, because we did taxation in the, what was it, the second term, you know very well that that would represent the accrual at the end of the year. In other words, your estimate for your income tax expense for the year. But here, this is not what we are going to disclose. Here, we are going to disclose what did we pay in terms of income tax, right? So that will be our first provisional tax payment for the year. That will be our second provisional tax payment for the year. There might have been a top-up payment relating to an underpayment from last year. So everything that we've paid to the various revenue services all over the world, everything that we've paid in terms of taxes will be shown as income tax paid. Whereas the income tax expense was our estimate at the end of the year, what we believe the income tax expense would be. And we know that we can have a whole objections and appeals process with the revenue services if they do not agree with our estimates. Right, ladies and gentlemen, let us just pause there. Are there any questions on that section? I think we've now spoken about the operations part. We've discussed why it's called customers. The five additional operating activities that's not part of your operations. That's not part of your day-to-day activities, but it is still an operating activity. By the way, when we say the operations, day-to-day activities, you know, sales and purchases happen on a daily basis, but you might only get interest on your current account, let's say once a month, or you might only pay interest on a loan once a quarter. You might only pay, let's say, 3 times a year on your income tax. So that's why it's not part of your day to day operations, right? It is something that happens occasionally. Dividends paid, as you know, might only occur twice a year when you pay the interim dividend and when you pay last year's final dividend, right? But anyway, let's just pause there for a few seconds. Are there any questions from your side? I think I can take that as a no. Okay, so let us proceed to our second activity section. and that is investing activities, ladies and gentlemen. So cash flows from investing activities or cash effects of investing activities. Now I'm going to ask you a few questions again. Let's see. I realize that most of you haven't encountered a statement of cash flows ever before, so it might seem a bit hard, or it might seem a bit harsh, I should say. But let us see what comes up, and then I will give you a few hints there as well. When it comes to investing activities, ladies and gentlemen, investing activities, it only relates to one section on one specific financial statement. Let me give you the first hint. The financial statement is the statement of financial position. The statement of financial position. Right. So what part of that statement of financial position does investing activities relate to? In other words, whenever we think about investing activities in the statement of cash flows, we only need to focus on one area. What do you think that is? I'll give you a few seconds, let's say 10 seconds to come up with something. Very good, very good, very good, very good. Some of you say fixed assets, some say PPE. Ayanda, Ayanda, and Asive. That is the answer I was actually looking for. Right. Any non-current assets. Thank you, Enrique. There we go. Okay, so that includes PPE, and PPE is includes fixed assets, right? So it includes property, plant, and equipment. It also includes intangible assets. It also includes, let's say, financial assets. It also includes biological assets, investment property, so any kind of non current asset, ladies and gentlemen. So, anytime you start working on your investing activity section in your statement of cash flows, you know you are now focusing on non current assets. Non current assets. Angel, a fixed deposit also. Yes, a fixed deposit. Maybe this is a good time to talk about that. Ladies and gentlemen, this is only a guideline that comes from IAS7. So it is not like a hard and fast rule. It is a guideline. So what IAS7 initially says or states is that if the cash is readily available, if it is readily available, then it should be seen as part of your cash and cash equivalents. Now, what kinds of cash is readily available? What is readily available is your current account, because you can go to your bank now and draw money from your current account. So it's immediately accessible. Savings account, right? A savings account, that's immediately accessible. You can go now and draw money. Then you get the sort of gray middle ground. Let's say you've got a 30-day notice deposit. In other words, you've got to give the bank 32 days notice before you can withdraw the money, right? Should that be seen as an investing activity, or should that be seen as part of your cash and cash equivalents? I'm not asking you. This is just a question in the sky. Okay. So what IAS7 gives us a guideline about, they basically say you can apply a three month rule or a 6 month rule. I think the originally it was the 6 months rule, but like I say, it's not a hard and fast rule. So if you can access the money within Mr. Cullinan, what is the most modern one? I forget now. Is it the 3 months or the 6 month one? I forget now. I'll have to go and look that up again, students. I'll come back to you on that. But let us just assume, maybe I should go and have a look quickly. No, that's going to waste too much time. But anyway, what they are saying, let's say, for instance, 6 months. It is 6 months. Thank you. I couldn't remember which one was the more modern one, the 6 months one. Thank you, Mr. Cullinan. I thought so. Okay. So if you are able, and this is the guideline given by IAS7, if you as a business or company or close corporation or whatever business you are, if you are able to access your money within 6 months, right, then it should be seen as part of your cash and cash equivalents. However, if you are not able to access your money within 6 months after the date, and we obviously now talking the date of your financial statements, right? If you are not able to access it within 6 months after the end of your financial year end, then it should rather not be seen as part of your cash and cash equivalents, but like Angel has said there, part of your investing activities. So, using that guideline, ladies and gentlemen, let me ask you a few short little questions again. If you've got a 32-day notice deposit, would you see that as part of cash and cash equivalents or part of investing activities? You can use abbreviation for the chat. If it's a 32-day notice deposit, cash and cash equivalent. Thank you, Tembela. Exactly. Exactly. Thank you, Nalasiwe. Thank you, Davina. Right. If you've got a 3 month fixed deposit at the end of the year, so it only expires 3 months after the year end date, should that be seen as part of cash and cash equivalents or part of your investing activities? Still cash and cash. Thank you very much. Still cash and cash equivalents. Thanks, Tim Vela. However, ladies and gentlemen, let's say at the end of the year, you've got a 1 year or 2 year fixed deposit. In other words, you cannot access that money within 1 year after the year end date. Then it should be seen as part of your investing activities. Right. Thank you very much, ladies and gentlemen. Now, just to conclude our discussion on investing activities, we said that the area that it covers is your non current assets. Somebody earlier actually mentioned it. Somebody, who was it? It was Kushle Mkabiles mentioned that a little bit earlier at quarter to 1. I want to also address that when it comes to your non-current assets and you are compiling your investing activities, in other words, the cash flows, there are only two possibilities. There are only two possibilities, ladies and gentlemen. You might have 7 or 8 line items because it could affect different kinds of non-current assets. The one could affect your equipment, the other could affect your let's say your financial assets and so forth. But there are only two kinds of activities. Only two. The one is the inflow of cash, right? The inflow of cash where you have disposed of some kind of non-current asset, right? So therefore we are going to not describe it, let's say, as equipment, because that sounds like you are drawing up your statement of financial position, but we would rather call it proceeds on disposal of equipment, or proceeds on disposal of financial assets, or proceeds on disposal of motor vehicles. So that is the one activity where there's an inflow of cash. What is the other activity, ladies and gentlemen? If somebody can type for me there, you can even look up there to that hint that was given. What is the other possibility? If it's not an inflow, but rather an outflow of cash. Thank you, Davina. The buying of assets. In other words, when you acquire some non-current assets, the outflow, buying of assets. So therefore, we are normally going to disclose that. Thank you, everyone. Tembela and Enrique, Davina, right? So that we will describe as acquisition of equipment, or acquisition of financial assets, or acquisition of um, motor vehicles, right? So you've only got the two situations. There are many kinds of non-current assets that could be affected. So you could have 3 or 4 or 5 or 6 line items there, but they will all only have to do with those two kinds of activities. Either the proceeds on the disposal of that non-current asset, which is then an inflow. And by the way, ladies and gentlemen, while we are talking about inflows and outflows, we also have to have a convention here. We have to have a convention, and this is very important. If it is an inflow of cash, we indicate it as a positive figure, right? A positive figure. If it's an outflow of cash, we have to indicate it as a negative figure. In other words, in brackets. Remember, just like all our other statements, we haven't got a debit side and a credit side, so we have to distinguish between it in a different way, and we do it by either showing it as a positive, and our convention here is that inflows are positive because that is good for us, right? We want money, so we want an inflow. It's a positive thing. And outflows we show as negatives. So anyway, I digress now, but that was an important point to make. So do not forget, if it's an outflow, to put in your brackets, ladies and gentlemen. Otherwise, you will not get that mark, right? And in practice, your directors or your chief accountant will say, "Whoa, where did you go to school?" Okay. Anyway, the point is, ladies and gentlemen, there are only two kinds of possibilities there: either an inflow of cash, which is normally the proceeds on the disposal of a non-current asset, or the outflow of cash, which is normally the acquisition of non-current assets. Okay, any questions on that section, ladies and gentlemen? Exactly, thank you, Angel. Right, outflow. Uh, Let me just read that. Outflow means your money becomes less, and if there's an inflow, it means your money becomes more, right? So the balances in your bank account or the cash in your safe is becoming more if it's an inflow, and if it's an outflow, it becomes less. Now let's go to our third activity, ladies and gentlemen: financing activities. Financing activities. Now, please, let's start by you giving me a few suggestions. What would financing activities be? And then I'll give you a little sort of tongue-in-cheek hint how to remember it. What would be a typical financing activity? What would be a typical financing? A loan? There we go. A loan. Usually not a share. Well, a share buyback as well. Yes, a share buyback will also be a financing activity, but it will be an outflow of cash, right? In the there are basically two possibilities, but quickly you're 100% spot on. Let me just scroll up again. Quickly is 100% spot on because you also have to go and indicate whether it's an inflow or an outflow. So in the case of a share buyback, it will be an outflow of cash. In the case of the issuing of shares, it will be an inflow of cash. And then many of you mentioned there, there quickly has also got the issuing of shares. So you've got both of them, right? So the issuing of shares will be an inflow of cash, and the buyback of shares, of ordinary shares, or the redemption of preference shares will be an outflow, right? Thank you, Angel. I like that description there. Proceeds from the issue of additional shares, right? So we will normally, in that case, call it proceeds from the issue of ordinary shares, or proceeds from the issue of preference shares, 7% cumulative preference shares, or whatever the case may be. And many of you also mentioned loans, ladies and gentlemen. So, really, in a nutshell, what your financing activities deal with is your own capital and loan capital, right? I like that because it rhymes. I'm like a kid in that in that way. Simply because it rhymes, it makes it easy to remember. So your financing activities deal with your own capital and loan capital. Own capital will be in our case, where we are dealing with companies, will be exactly as many of you mentioned. There will be your share capital, either your ordinary share capital or your preference share capital, right? So, ladies and gentlemen, when it comes to own capital, it refers to share capital, either, like we said, ordinary or preference. When it comes to loan capital, it could be an actual loan itself. So you go to a bank and approach them for a loan. But you also know that there are certain loan instruments in the market. We discussed that in the first term, like debentures or bonds, right? So it could also be if you are issuing debentures or you are issuing bonds, you are borrowing money from the public or from many institutions, not just from one. But that still causes an inflow of cash, and it still raises a liability in your statement of financial position. Right. And again, almost similar to when it came to the investing activities, there are really only two kinds of happenings or two kinds of occurrences or two kinds of events that can take place. What are they, ladies and gentlemen? It's either an inflow or an outflow. In the case of the shares, you don't have to retype it again because I think Kusleb mentioned both for us there. In the case of the outflow, it will be a share buyback of ordinary shares or a redemption of preference shares. In the case of the inflow of cash, it will be the issuing of shares. And then we're going to describe it as proceeds, like Angel said, the proceeds from the issue of, let's say, 7% preference shares. A silent leaseback, yes, Ayana, a lease in general, but leases we are only going to do in financial accounting 3. So you are quite correct, but because we are only discussing leases in financial accounting 3, you won't find it in any of our financial accounting 2 questions. And when it comes to loan capital, ladies and gentlemen, as we've said, again, it can only be two possibilities. Two possibilities. Either you are acquiring a new loan or you are repaying a loan. So if it's an inflow of cash, it will be acquisition of loan, or it will be proceeds on issue of debentures, for instance. When it comes to the outflow of cash, it will be the repayment of loan or redemption of preference share capital, right? Sorry, that is part of our own capital. Well, it depends. As you know, uh, preference preference shares can, under certain circumstances, be regarded as a liability instead of equity, even though we treated it as equity at the beginning of the year. Okay, ladies and gentlemen, so far so good. Then it's only our last section. We've basically discussed that already. You get your cash and cash equivalents at the beginning of the period. You get that directly from your statement of statement of financial position. Sorry. And we've given you the warning there. Also look under your current liabilities in case there was a bank overdraft, right? If you have various various kinds of accounts that make up your cash and cash equivalents, that will cause you to have a little additional note, a note that will just disclose what are the various accounts that make up your cash and cash equivalents. Normally in financial accounting too, we will only have our bank account and possibly a cash float or something like that, right? Yes, thank you, Angel. And a bank overdraft, you must remember that will be under your current liabilities. And when you disclose it in your statement of cash flows, you must then disclose that as a negative, otherwise it's not going to add up. So in any case, your cash and cash equivalents at the beginning of the period, you simply find in your previous year column, the comparative figures column of your financial statements, and this one you find in your current year column. Which brings us to almost our last argument for the day, ladies and gentlemen. It is possible to draw up your statement of cash flows just by using the information in the rest of your financial statements. So if you've already drawn up your statement of comprehensive income for the year, you've already drawn up your statement of changes in equity for the year, you've already drawn up your statement of uh, 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 what did I just say? Changes in equity. So your statement of financial position, and you've drawn up the notes relating to them. From that information, you can get your enough information to draw up your statement of cash flows. In fact, it is possible to program. If you are drawing up your financial statements on Excel, for instance, and you are going to type in the figures for the other financial statements, it is possible to program your Excel spreadsheet that it draws up the statement of cash flows by itself. I've actually done that. So, in any case, that just something to bear in mind. If you've done all the other financial statements, all the information you need to draw up your statement of cash flows comes from the other financial statements. Uh, Sometimes if you haven't drawn up the notes yet, you might have to refer back to some of your ledger accounts. But if you've drawn up the notes as well, then all the information should be in your financial statements. Okay, so that is the face of our statement of cash flows, ladies and gentlemen. That is the format. We're going to stick to this format. We've looked at what they mean. Operating activities is your normal activities, your operations is your day to day trading activities. Just one other thing, ladies and gentlemen, that I wanted to mention is that you have the choice. You can put your subtotal for each section either at the bottom of that section, right? But if you put it at the bottom, if you disclose it at the bottom of the section, you've got to give it a little description. So if you've decided you're going to disclose the total of your operating activities there, then you will have to call it net inflow or net outflow of cash from operating activities. Your alternative is to simply disclose it next to the heading. That is normally the way that I follow in any case. There's no one way better than the other. It is really your decision as an accounting. I prefer simply to have my totals next to the headings, right? So I'll have my subtotal there, and I'll have another subtotal there. I'll have another subtotal there. But like we say, if you prefer to show it at the end of each section, then you've just got to give it an appropriate little description. Let me just see. No, there was nothing there. Then just the last word, ladies and gents, on the note. When it comes to the note, everything now sort of changes, as we've said earlier on. Now we are not looking at cash flows. We are working our way towards a cash flow. I'm going to repeat that because it is important to understand. When we are looking at the note, in other words, the indirect method of calculating our cash generated from operations, the story is different. Here we are not disclosing cash flows, we are working our way towards calculating a cash flow, right? So, ladies and gentlemen, as we said earlier, we are going to start with the profit before tax, which is a figure that comes from our statement of comprehensive income, and it was derived by using the accrual basis or accrual system. And then we've got to take out those income items and expense items that do not relate to operations. So here we can see, what are we going to adjust for? Depreciation is an expense. Here we call it interest income. So it is the income, it is not the cash flow. On the face of our statement of cash flows, it was the cash flow. So here it was interest received, the money. But this is now a different figure, or in most cases, it will be a different figure. Here we adjust for the interest income, the one that is part of our revenue, that is included in our profit before tax when we drew up our statement of comprehensive income. Here we've got our interest expense, not the interest paid. Here on the face of the statement, we had interest paid. But now when we do our note, the indirect method, we are adjusting First of all, for income and expense items that are not part of, where is it? Not part of that, not part of operations. And then, secondly, once we've done that adjustment, we are going to nullify the effect of the accrual system by looking at our working capital changes. But that, all of that, we will discuss when we do our various exercises. Or I know Mr. Culloden has also drafted very good notes. So we will discuss that at a different stage. So at this point in time, ladies and gentlemen, before we actually carry on, I know we are almost done for today, but I mean, before we carry on with this whole topic of the statement of cash flows, are there any questions on the format? Because that is really what we were discussing today, is the format. Any questions? Can I take that as a no? Then at least we can give you a 5 minute break. Mr. Culloden, was there anything that you wanted to add? Thank you, Enrique.
Not at all, Mr. Colin. Everything seems to be going well.
Okay, thank you so much. I will communicate with you during the course of the week about next week. But you know everything that you need to do. So, but just about whether we're going to share next week, or how we're going to do the online part. All good. Thank you, Angel. Thank you very much, students. Thank you for attending. Now you can have a little break before your next class. Will there be a quiz again for this topic, Enrique? Yes, not now, but let's say before we get to the class test, right? Let's say in about 2 weeks' time or so, we will make available a quiz on this topic. So then you can practice your skills and you can practice the way that it will be asked, right? So there will be a quiz on that as well as on uh, foreign exchange. Thank you so much, students, for attending. Enjoy the rest of your day and your other classes, and have a good evening later on. Bye bye.